Hey there, Steve Rubis with another installment of Capital Markets Investor Relations in 2 minutes or less. Today we're going to do part one of valuation considerations stemming from our discussion of the Dayforce short attack. And the key premise is this, that the right inputs will make or break a valuation for a public equity investor. And consensus matters in this case, and there's two variables that an investor needs to consider, and that is time frame and valuation metric. If you select one of these or both that are outside of consensus, you may get bad outcomes in terms of your analysis. So in today's video, we're going to walk through the different time frames that you can select as an investor to understand the valuation of a stock. And there's four that we'll walk through. The first is last 12 months. The second is next 12 months or current year. Third is fiscal year plus one, which is the first out year, and then fiscal year plus two, which is 2 fiscal years forward. Now, to give a practical illustration of these four time frames, we're going to take a company whose year end is 12/31/23. So in this scenario, it's very simple. Last 12 months is January to December of 23. Next 12 months is January to December of 24. Fiscal year plus one is January to December of 25. And then fiscal year two is January to December of 26. I put a green box around fiscal year plus one because this is the sweet spot of valuation for most growth-oriented investors. What they're trying to do is estimate into the future what the company can do and discount that outcome back to the present to get a sense of valuation and determine if it's undervalued, overvalued, and what's missing in terms of the narrative in the stock. So forward valuation multiples matter, and there's 4 reasons. The first is they illustrate valuation disconnects. If forward multiples are significantly above or below current multiples or peer multiples, that's telling you there's a disconnect in the market and there's some sort of debate that people need to consider. Number 2, they tell you what is and what is not in the stock. If you have a company that is showing extremely low forward valuation multiples, but management has identified a series of catalysts, that's telling you that investors don't believe the catalysts or the plan the company has put forward, which signals there's work to do at the company. Which leads to number 3. Disconnects in forward multiples help investor relations officers and executive teams identify key debates in the stock and then go to work to address and inform those key debates to get the outcomes they want. And then fourth, it allows you to get a sense of where do investors disagree or agree with management. And again, it sends a signal to the investor relations and executive team where there are disconnects in the narrative and in the catalyst pathway that they can then go work on to educate better or better develop in order to unlock shareholder value. Always here to help. Thanks for watching.